In this exercise, we are going to go through the pricing of bonds. We're going to walk through the solution. So the data set here is that Joe has recently started an internship at SJP Investing. As part of his training, his supervisor asked him to review the pricing of certain bonds to see if they reflect the fair value of the bond. Calculate the price of the below two bonds. So we're going to see bond A and bond B here. Now, the first one is a 10-year bond that has a face value of $100,000, a stated interest rate of 9%, and a market rate of 7%. It pays interest semi-annually, which is twice a year. So requirement 1, what is the cash interest that would be paid every interest period? Now keep in mind, the interest period is a 6-month interest period. So we have two things to remember here. To calculate the cash interest, we have to use the stated interest rate. But we also have to remember that the rate is always given in an annual form. We want a semi-annual form. So if it's 9% per year, it's half of that twice a year, every semi-annual period. So we will take 4.5%, half of 9%, multiplied by the $100,000, and we will find out that the interest payment will be $4,500 per interest period. Requirement 2, how many interest payments will be made up to the point of maturity? It is a 10-year bond, but there are 2 payments per year, so there are actually 20 interest payments. Requirement 3. Now that we have some of that information, we're going to be using the tables, I'll just say present or future value tables for right now. Rather than using a calculator, rather than using Excel to price this bond, we're going to be using tables. Time value of money tables, that's a generic term. So the question is, which two of the 4 tables do we need? We have present and future value of $1, lump sum, present and future value of annuity. We only need 2, and they are going to be the 2 present value tables. The whole thought is that if we're paying money for a bond today, we want to know the present value of all of those future cash flows that we will get. The future value tables have nothing to do with bond pricing. Now notice we have a tab down here for each of the tables. Requirement 4, which interest rate will you be looking for in each of the tables? So if we go back up here, we have 2 different interest rates listed, but remember we have semi-annual periods. So what we need to remember here is that when we're looking at the tables, that's when we use the market rate. But we also have to account for the fact that it's twice per year. So instead of using 7%, we use half of that, which is 3.5%. Now that really gives us everything we need to price this bond. So we're going to determine the price of the bond using this little chart down here. And I'm going to put in a description. The first table would be the present value of $1. And the second table would be the present value of an annuity of $1. Now we'll get the table factors in just a bit, but present value of $1, the amount we're going to multiply that factor by is going to be the $100,000 face value. For the present value of an annuity, this is where we have to go up and find one interest payment. So $4,500 will be the amount we put in for that factor, that value. Now let's look at the present value of $1 table. So we need to find the 3.5% rate and 20 periods. 10 years times 2 periods per year, 20 periods. So that is the present value of $1, 3.5%, and 20 periods gives us a factor of 0.5026. 0.5026 is 20 periods and 4%. 20 periods and 3.5%. 0.5026. The present value of an annuity of $1, still 3.5%, and still 20 periods, but now the annuity factor is 14.2124. So let's think about that for a second. The present value of $1, that factor is less than 1, which is what we would expect. The present value is always going to be less than 1. The longer the time period that we're using, in this case 20 periods, the higher that number, the lower your percentage is going to be, because the present value is worth less, because that money is coming out so far in the future that when we bring it back to the present value, it's not worth a whole lot. The annuity factor, keep in mind, this is one payment we're multiplying this by, and we're going to have 20 of them. So we would expect this table factor to be less than 20. And it is, 14.2124. So now we can multiply the factor times the amount for both lines, and then we're going to add those two amounts up. So this is giving us a $114,215.80 bond price. So let's think about that to see if it makes sense. The bond price is about $114,000. The bond face value is $100,000. What this means is we're selling this at a premium. We're selling it for more than the face value. So the question is, does that make sense? Our stated interest rate is 9%, which is higher than what the market is currently paying. So yes, indeed, a premium makes sense. We're selling it for more money. They're getting more interest out of it, so they need to pay more for the bond. It's a good investment. So the $114,000, and the other kind of the quick test, is it at least close to $100,000? If you came up with something like $1 million, $700,000, or $5,000, that's way off track. Regardless of whether it's a premium or discount, your number should be reasonably close to your face value. $114,000 is at least in the ballpark. So now let's take a look at bond B. Still a 10-year bond, has a face value of $100,000, a stated interest rate of 8%, and a market interest rate that's higher at 9%. This one pays interest annually once per year. So requirement 1, based solely on what we see above, do we expect this bond to be priced higher, lower, or equal to bond A price? Bond A was a premium. Bond B, we pay less interest at 8% than the market currently pays. This is going to be a discount, which means the price should be lower than the bond A price. It's going to be less than $100,000. So requirement 2 for bond B, we're using the same methodology. We're going to determine the proper price of the bond. So we're still using the same tables. Present value of $1, present value of an annuity of $1. It's still the $100,000 amount that we used, but this time the cash interest payment is going to be different. It's $100,000 multiplied by the stated interest rate of 8%. So now it's going to be, and it's once per year. So it's $8,000. The table factors are also going to be different because now we're with an annual interest payment. So now we're actually using these full annual rates, and we're using a full 10-year period. So keep in mind, we use the market rate of 9% for the tables. So 9% in 10 years, 9% all the way down to 10 periods gets us 0.4224. The present value of an annuity of $1, 9%, 10 periods, gets us 6.4177. Again, still below the 10 periods. So now if we multiply the amounts again and add them up, this time our bond price is $93,582, which is less than the face value of $100,000. It's certainly less than bond A's price. This is as we predicted. So this should take you through the bond pricing. Hopefully this helps to clarify how to price a bond using present value tables.